Hello again. Here's Chapter 2, Analyzing Transactions. I'm hopeful that you were able to get through Chapter 1, as it is a basis upon which everything that we're going to be doing will lay. Here's another chapter that I think is extremely important, Analyzing Transactions. You're going to have so much fun analyzing transactions because it's really the core of what accounting is. It really begins with you going through this cycle of determining what type of transactions you need to record, how to record them, what's actually happening, and then ultimately looking at the effect of those transactions in various reports and ratios of that you'll calculate. So using accounts to record transactions. Again, there are many accounts. Think about in your own personal life. When you are dealing with everyday activities regarding your finances, you have your income from your salary, right? You have your mortgage to pay or your rent. You have to pay for food. You have to pay for clothing. Think of those type of transactions are as a basis upon which accounts are going to be derived. For example, if you're going to pay for groceries, you'll probably say that would be grocery expense, or you're paying for you buy furniture, you'll buy an asset you'll purchase, and that'll be your furniture. Or you'll buy an oven, which will be, again, furniture or some type of asset that you'll purchase. Or in this case, you pay for a credit card bill. That would be some kind of obligation that you'll be paying for. Or you have an expense and you talk to your lawyer or something like that. You have your expenses. Very much like that. If you think about your accounting in that sense, you could kind of draw some correlations between your own personal accounts that you have to deal with and also accounts within the accounting perspective, and it probably make it a little easier to grasp. We'll be using T accounts, and T accounts really allows you to represent what's happening with a particular account. For example, supplies expense, or no supplies. When you buy various supplies and you're increasing those supplies, and every time you make a purchase, you put that transaction on that T account, and it gives you kind of a running sum of the balance of that account. So it gives you an item of what's really going on. A T account allows us to see both the debit side and the credit side of these various transactions, with the T account showing on the left side being your debit and your credit side being on your right side. And again, depending on the different accounts, we're going to see the transactions affecting it, being increasing it or decreasing it. So for example, cash has a normal debit balance. It increases with debits. So therefore, whenever you see an asset going up, you know that you're going to be putting that transaction on the debit side of your T account on the left. But when you want to decrease the cash, you're going to be putting it on the left side, and it's going to be a credit. Debits on the left, credits on the right, regardless of what account you use. However, depending on the account, certain accounts increase with debits and certain accounts increase with credits. And you need to know that as well, which I think is quite important to understand the relationship between debits and credits and how it is different depending on the account that you're trying to affect. So a group of accounts are called a ledger. All the accounts in the ledger are called a chart of accounts, and you'll see that also in your project. You'll see it within your workbook. You'll see there are a number of accounts that you'll be using, and they will be grouped by assets, liabilities, equity, revenues, and expenses. Assets are, again, what you own. You can use them. You can control them. You can even sell them. It's yours. Liabilities are obligations. You owe to someone else, some outside entity. Equity is going to be the right to claim the assets. It's actually the residual. It's left over after you pay all your obligations. And common stock and retained earnings are going to be represented on the corporation side. Okay, so again, corporations you're going to see common stock and retained earnings. And when dividends are paid out, which is going to be represents a distribution to the owners of the company. Revenues increases assets and equity. Okay, so when you're looking at revenues, what effect does it have on the accounting equation? It's going to be an increase in equity. Okay, expenses are going to be used up, consumed, using up of assets. Again, it's going to be a decrease in equity. Very important to note that. So in a double entry accounting system, you're going to make certain that every entry has a debit and a credit. They must balance. It does not mean that you have to have a certain number of assets and a certain number of credits. You just need to make certain that your debits and your credits in total agree. We want to make certain that our entries balance. And this is very, very important. This is absolutely vital for any of your entries to be accurate. You must ensure that your assets and your credits and your debits equal, that your entries always have two sides. Normal balances. Again, we want to know, what is a normal balance? Well, it depends on the account. A normal balance can very well be assets. Assets have a normal debit balance. Equity has a normal credit balance. That also includes revenues. Expenses have a normal debit balance because they are using up assets. They use up assets and they decrease equity. Therefore, it's going to have a normal debit balance. Liabilities, on the other hand, have a normal credit balance. So understanding that is very, very important, because journalizing is going to be something that you're going to be doing quite a bit in this course. So we want to make certain when we journalize, what do we want to do? We want to make certain that we are clear on the time frame. The date is going to be important. The title of the account to be debited is going to be on the left hand, and the description, and so forth. What I want you to understand is not so much going through steps, but understanding what you're doing. We're recording transactions. We want to be sure of our time principle. So that means we have to make consideration of the date of that transaction. We want to make certain that we know exactly what we had with the transaction. It has been accomplished. If it's a sale, we want to make sure that we're going to show revenue. In this case, if we receive cash as a result of that, we'll make sure that we have cash. So knowing the accounts, knowing the title of the accounts and the description, exactly what's happening, is very, very important, because that's how you can accurately record various transactions. And the recording of the transaction is called a journal entry. When we move those accounts and transfer them to the various T accounts, in this case, we're actually posting them. Now, one of the things that you need to know also is when we create a liability, that means we have an obligation. Sometimes when we receive money from our customer before we actually do the work for them, we owe them the service. So that's an obligation. So revenue hasn't been earned at that point. And again, knowing what accounts receivable is important. These are many, many different terms, but they're actually pretty easy to understand. So when you do something for a customer, but they have not paid you yet, you have an expectation, and it's going to be called accounts receivable. A trial balance is going to be, again, all of the transactions on a ledger, then debit credit format. So a trial balance, as it states, has to balance. And again, you want to have your trial balance prepared in good form. Following these steps will allow you to do that. And again, knowing what the purpose of a trial balance is important as well. Again, a trial balance allows us to prepare our financial statements. So it's important that we create these transactions accurately through journal entries, transfer them to our T accounts in our posting, and then transfer them then to our trial balance in debit credit format. An unadjusted trial balance is the first step in preparing our financial statements, because again, we have to make certain that all of our transactions have been entered in debit credit format, but then there are various accounts that we may have to adjust, which means that we create these adjusting entries, and then we have our trial balance adjusted. Now, right here are the kinds of problems and errors that are common when you're preparing your trial balance. I'm going to mention things that are not mentioned here. One of the things I think one of the major problems with the trial balance, and why they're always wrong, is that you forget that you have to prepare it in good form. Your assets should go first. Your liabilities should be second. Your equity, your revenue, and your expenses. Following that order is extremely important. That's good form. Also, there are times when people make a mistake in putting an asset in the credit column, or vice versa, putting a liability in the debit column. Knowing that can be one of those types of errors that can be created when you're actually preparing a trial balance. Can be helpful when your trial balance doesn't balance. Sometimes you can transpose numbers, which I think is mostly an infrequent event. The most common error would be putting an asset in the credit column or liability in the debit column. Generally, those are the kind of errors that I have seen. Now, again, decision making is very important. We prepare these financial statements and they look wonderful and they're absolutely accurate, but how do we know what they mean? How do we interpret what they mean? Analysis for decision making, horizontal analysis is very important. And we also talked a little bit about ratios. Ratios are another tool that you can use to analyze financial statements, not only the ones that you're preparing, but also the ones you review of other companies and organizations. This chapter is an extremely important chapter, and I think you'll learn much. One of the keys that you should take from this is understanding accounts and what they mean, understanding the normal balances that are associated with those accounts, understanding the purpose and the role of a trial balance, how to detect various types of common errors that you might have, and also understanding the nature of double entry accounting. I thank you very much for your time, and I hope to talk to you very soon.